All right, thanks so much. All right, well, welcome. I'm Mark Foster. I'm the Director of Education with nonprofit CCOA, Credit Counseling of Arkansas. We've been around since 1995, helping people with personal finances. It might be budgeting, credit, debt issues, home buying, home issues, and so forth. Just a wide variety of things, credit reports. But what we're going to look at tonight is navigating debt. And why? Well, honestly, virtually everyone has debt of some kind. It might be credit card debt, might be a home loan. I mean, few people own their home completely outright and no mortgage. And then there's medical debt. That's a big one. Bless you. Yeah, medical debt, man. With our family of four, that was always kind of like the bane of my financial existence. Even with insurance that we had, it was, boy, that just adds up. Here we go. Put these suckers on. There we go. A third of Americans have debt in collections. Half of Americans say the amount of debt that they have causes them stress. 60% believe it's going to take them over 5 years to pay off their debt. But here's the thing, debt's not some kind of personal failure. You know, the image of someone who went on a wild shopping spree and spent a whole bunch of money, sure, there are people out there who do that. That's not the majority of people. The majority of people, it's life happens, life events, such as a pay cut or no more overtime. Boss says no more overtime, and people are like, I was counting on overtime to make ends meet. Unemployment, serious illness, medical emergency, divorce. Typically, we say the only financial winners in a divorce are like the attorneys. It's just financially devastating, typically for both parties. Natural disasters. We had a flood in our city. When was that? Anyway, I think it was last year. And the water came, the closest it's ever come to our house, it came up to about like 6 feet away. And it was like, oh my gosh, and I don't have flood insurance. And thankfully we didn't get hit with the water, but there were a couple of people from our church who lived about a half mile away, and it flooded their homes, and they didn't have flood insurance. Yeah.
In a floodplain, or your foundation is falling apart and you're on a hill.
So that's a financial bite if you get hit with that. And then there can be predatory financial products out there that people may pay through the nose for. So goals for today, shared learnings, and we'll talk about some things. Next steps, what am I doing? So you're going to have a plan of what am I doing? What's my plan for me? What's that look like? We'll take a look at that, and certainly feel free to ask questions and ask questions as we go. If you're like me, if you hold all your questions till the end, by the time you get to the end, it's like you've forgotten what the questions were. So we want to bring down our debt load. There are a lot of different paths people can take to do that. Making consistent payments, of course, ways to ease the debt burden and getting some help that's available out there. So we'll take a peek at, first off, different types of debt that people may be interested in tackling. Could be credit cards, personal loans, home or auto, student loans. That can be a lot of money. Tens of thousands of dollars people may have, $50,000, $60,000, $70,000 or more in student loans. Medical debt can certainly add up, even if someone does have insurance. Is there a certain one that interests you more than others?
Yeah, definitely for my wife, student loans.
Student loans.
And then me, a couple defaulted credit card loans.
Credit card, okay.
The student loans, I actually did a pretty good job paying off through through college. I worked my butt off for it. So I graduated with only under $10,000 of student loan debt.
Okay.
So I'm okay there, but I would like to, for me, I want to look at kind of consolidating like defaults and working on my credit score, kind of the
Okay.
points of interest for me. I buy my cars in cash when I can. I try not to finance. It's the only fiscal responsibility I was raised with, I think. And so not an issue there either, or with personal loans, unfortunately not with medical debt yet. So,
Okay.
yeah.
We'll go through this, and you got some questions that we don't hit, touch on the topics you're interested in. Yeah, just fire away, and we'll touch on those.
Yeah, I'll take all the information for sure. I'm not
Okay.
gonna avoid this, moving forward. So,
All right. So what's most important to you, reducing the cost of your debt, or the number of debts that you have, or your risk of property loss, or something else?
probably reducing the number of debts that I hold. I'm
Okay.
just kind of checking them off, right?
All right, reducing the number of debts. And how we organize that, there's a good strategy for that. Making the minimum or monthly payments on all your debts, and then setting aside any additional money towards your priority debt. Sometimes people pay extra on their debt, which is very commendable, but sometimes people will try what I call the shotgunning approach. And they're like, well, I'm going to pay some extra on this one, and this one, and this one, and this one. And that's admirable to tackle those debts. But research shows that financially, that's not the optimum way to do that. The optimum way is to have public enemy number one. Well, I'm targeting this one. Now, there's a couple of different ways to do that. People can target, the best way to go is to target the one that's the highest interest rate, because that's the one that's costing you the most money, the one with the highest interest rate. But it's kind of like the debt snowball versus debt avalanche approach. Both are great. One is slightly better. If you say, like a lot of people might say, well, I want to target the smallest one so I can hammer it out. And yeah, I feel good. I feel like I feel that success and that achievement, and then go on to the next smallest one and knock that out. A lot of people want to do that. And that approach is very good to do. It doesn't save you quite as much money as if you target the one with the highest interest rate, but what Emmy Award-winning financial reporter Stacy Johnson says, who hosts Money Talks, and I've met Stacy, an outstanding professional in person, and Stacy says, targeting the smallest debt versus the highest interest rate, true, it's not going to save you quite as much money, but the difference is going to be very small. So it's not like you're going to spend thousands and thousands of dollars more if you target the smallest debt instead of the highest interest rate. It'd be like the difference is, well, instead of getting an A plus, I got an A. Like, well, I can live with that, So what people could do is they can, if they're not sure which way to go, they could always target the highest interest rate. And if they feel like this is just not working for me, I don't feel motivated, and switch over and hit the smallest debt, But whichever approach you take, target that with your extra money. And then after you pay off that debt, then you roll over that payment onto the new public enemy number one. And that extra money and the payments that you made on that one debt, now you pay it on this next one. And it goes pretty fast when we do that. Try not to take on new debt. We'd say it's hard to put out a fire if you're pouring gas on it. So adding new debt while you're trying to get out of debt is best avoided. Avoid putting medical debt that's at zero interest and fees on a credit card if you can, for as long as you can, because the credit card is typically not zero interest unless you got an introductory offer or something. Avoid paying off credit card debt with your home equity or title loans that can put your house or car at risk. And avoid loans with variable interest rates, which might be cheaper now, but they might shoot way up later and get a lot more expensive. Sometimes people can struggle to meet payments. Are there any challenges you face with your debt, like a due date that just isn't very convenient, or high fees, or there's other urgent financial needs, or something else? What are some challenges that you might face?
Yeah, for me, it was structure in general. I've been very fly by the seat of my pants until this point in my life, so.
Okay.
Just getting on top of it, getting a hold of it, and kind of finding a way to structure it and face it, really.
Okay.
Yeah.
Well, this should help you create your own plan, and then of course the financial professionals at CCOA are always glad to help with a free counseling session and free financial assessment. People say it's free, what's the catch? I say, I like your thinking. I teach classes on scams and identity theft, but in this case, free is free. Because it's grants, and more grants that basically allow our nonprofit to do that. For easing your credit card debt, there are some tips that people can do. You can call your lender. The sooner the better. You might want to ask them to waive a late fee. If you've never done that before, they're very, very likely to do that. They typically won't do it unless you ask. But I remember calling up a lender one time many years ago and saying, oh, I got a late payment. I don't know how that happened. And they're like, oh, well, that's the first time that's happened. Tell you what, Mr. Foster, we'll go ahead and remove that as a one-time courtesy. And I was like, ooh, thank you. If your due date is a problem, like if your due date is on the 13th and you're like, man, that's hard because I don't get paid till the 15th, and I just, struggle with that. And sometimes, later, then I just ask them, call them and ask them, hey, can we push that back to the 15th? That's when I get paid, and that won't be a problem if I can do that.
Do you think it's beneficial to kind of keep all of your bill payments around the same date, or is it just kind of depends on the person there, or?
Is it best to keep all your bill payments around the same date?
Yeah.
It really depends on you and your situation. If it's easier, if you can afford to do that, and you're like, it's easier for me if I can have all of that come out the last week of the month, for example, and you can financially that works for you, and you're like, logistically and logically that works for me. I'll have that mindset. The last week of the month is when this, then yeah.
If not, tier it out based on your budget, what you can afford.
Yeah.
Basically.
You bet. Some people might make notes on their paper calendar or their computer calendar, that kind of thing. So on with medical debt, you might want to ask your healthcare provider to see, what's your financial assistance policy? See if you qualify, if they can lower the amount that you owe. Ask, hey, can you bill me the same rate charged to insurance companies or Medicare or Medicaid? Or if someone's self-pay, they can say, can you give me the self-pay discount? And instead of waiting for months for you to get paid through insurance, I can pay you today or whatever if I'm self-pay, or this week or something like that. Student loan debt. You might want to talk to your lender about adjusting monthly payments based on your financial situation with an income-driven repayment. That's one option.
And what does that mean exactly?
What's that?
Income-driven repayment, what does that mean exactly?
It's your repayment amount will be based on how much money you make.
And do they help you decide that then, or is that something that you?
I think they have I think it's already done in a chart.
Yeah.
and you say, here's how much money I make, and they'll go, okay, well, we'll take a $60 a month payment from you or something like that, you know. So you can ask them about that income, based on your repayment based on your income. Loan consolidation, if you have multiple federal student loans, you can kind of consolidate those. And then loan forgiveness, like if you're working for a nonprofit for so many years, 10 years or whatever the number was, that can be an option as well.
Basically nonprofit or medical field, things like that.
I think it has to be like a nonprofit. Our counselors can tell you more of the specifics on that, but yeah, if you're working for a for-profit, that doesn't really work. But a nonprofit for so many years, then you can qualify for loan forgiveness, which historically has been horrible. Where they'd say something like, 1 million people qualify, and only 3 have ever been forgiven. It's not quite that, but you get the idea.
Is it so the lenders then are the ones that kind of restrict the forgiveness there? Is what's happening, like as far as tightening it up and not allowing everybody?
Why were people not? Yeah, that's what Congress and everybody was asking. It's like, wait a minute, if these people qualify, why are they not getting it? So that's been the huge thing in the news, and it is getting better. I don't know if it's where it needs to be quite yet, but it seems like it's moving more in the right direction. Debt settlement companies promise to negotiate with your lenders for you, and debt settlement is you're settling a debt for less.
So would you recommend doing that on your own then, kind of negotiating that?
The thing we like to tell people about debt settlement is, like they point out, they'll often charge you more than you're going to end up saving. These are typically slow with low success rates. It's like you pay us money for 6 months, 9 months, or whatever, and then we'll make an offer to try and settle it. It definitely is a big bad mark on your credit. It can destroy your credit in the process. A lot of lenders won't work with them.
Why is that? Why would that destroy your credit?
Because you're settling a debt for less.
Okay.
Because you're
credit then.
yeah, because it's like, well, you owe $1,000, but you only paid $500, and they said, okay, well, we'll settle it for less. So because you're not paying as agreed, and you're paying like half of what you owe roughly, it's a big bad mark. And the thing that they don't go out of their way to tell you, that's actually not on that slide, is a lot of people get surprised with something in the mail. They're like, what is it? Taxes. The IRS will treat forgiven debt of $600 or more as earned income. So if you settled, let's say you settled a $3,000 debt for $1,500.
Essentially, the amount that you didn't pay.
The amount you didn't pay, the amount that you got forgiven, the IRS will say, well, that forgiven $1,500, yeah, it's like you earned that $1,500. We're going to tax you on that, and then you pay tax. A lot of people get a nasty surprise on their taxes. So there's some downsides for that.
So if you already have these in default, though, they've already been sold off, essentially. I mean, you don't really have a choice but to pay, right, that lower amount.
If you what?
If these debts have already been like defaulted and been sold off, you don't have a choice but then to pay that lower amount, right, to whatever company is trying to collect. Does that make sense?
You don't have a choice with who you're dealing with? Is that what you were saying?
Yeah, if they've sold off your debt, right? Mm-hmm. Like I have a DirecTV debt, I didn't know about until after it was already sold off at like $300, right? And now I'm gonna have to deal with another company who's like, give us $50, give us $100, right?
Well, there's debt settlement where you're dealing with like that company directly.
Yeah.
And then there's debt settlement where you go through like a third party.
Yeah.
that, yeah, neither one is necessarily a great option, but when you go through a third party, they're like, well, just pay us hundreds of dollars every month for the next 6 months, 9 months, or whatever. Once we get enough money, we'll go make an offer. They have low success rates, and it's very expensive. And we've had a lot of people come to us saying, well, I started off trying to do this. It didn't really work well. So now we're coming to CCOA to talk to you about, what we can do with our debt instead. But there's free counseling, financial analysis and counseling at CCOA, like I said. You don't have to go it alone. Our average counselor has 21 years of experience. They've been doing it a long time. And in a free 1 hour session that's done in person at Bentonville, Fayetteville, or Fort Smith, or over the phone, we do phone sessions as well, or via email. They create a budget with someone. They work with them on creating a budget that's doable and realistic for that person, and not just looks good on paper, but is this something that really will truly work with these different categories and so forth. And then they can help people develop some kind of a plan for payment. There's also a debt management program at CCOA. If people choose to go on that, and about 20% of people do, majority don't. But then they have an action plan of tips and strategies that they can take with them, and then they also may hear about some resources in the community or some consumer protection laws or things that might benefit them. With, let's see, I'll talk more on the DMP here in a minute. But in the free credit counseling session, they're counseling. There's Mary, who was going to be here tonight, but she's sick. But Mary or one of our other counselors will discuss your financial goals and your priorities. They're caring, they're non-judgmental. People always sound surprised. Oh, wow, I was kind of expecting someone to, be kind of judgmental about my situation or something, and I'm just so thankful that they were caring and supportive and encouraging. And Mary is a big cheerleader for our clients, and people just love meeting with her. So, but she or one of our other counselors will just kind of review your overall finances.
She's here in Fayetteville?
She is, and you'll get individual guidance. It's not cookie cutter counseling for your situation and your resources and financial abilities and so forth. Some tips and strategies for strategic spending and savings and reducing your debt. Let's see. Sorry, my numbers on that slide are 1, 1, 1, and 1. That's just to see if you're paying attention. So you didn't mention it, so I think I snuck it past you there. This one goes 1, 2, 3. Yay. But a debt management plan, if you've heard of a debt management program, debt management plan. This is not debt settlement. Debt settlement, you're settling a debt for less. Right. With debt management, you're paying back your debt in full. So if you owe Discover Card $1,000, you're paying that $1,000 principal amount back in full, or Citibank $2,000, you end up paying that back in full within a 3 to 5 year plan. But a debt management program, the creditors agree, okay, well, we'll lower your interest rates, we'll stop late fees and over the limit fees, plus lower your monthly payment, which gives you more breathing room. The interest rate thing. I mean, I had a friend of mine one time call me, just in tears, and he said, I got four credit cards that have defaulted to 29.99, basically 30% interest each. And he said, I'm shelling out $400 a month in minimum payments that I have to pay because of how high everything is on those things, and that's how much of a minimum payment they want total on those. And he says, out of that $400 a month, he said, $40 is going towards my principal, and $360 is being gobbled up as interest and fees. So he was a perfect candidate to go on a debt management program. And his interest rates dropped from, 30% down to something doable like 6 or 7% or something like that. And they stopped smacking him with late fees, over limit fees, and that kind of thing. So it can be beneficial to save people literally thousands of dollars in interest and fees while they're paying their debt back in full in 3 to 5 years. Sometimes people, it's like, they're like, well, a debt management program sounds nice, but that's like bailing the Titanic out with a teacup. It's like, that ain't gonna do it. I'm way beyond that at this stage. And some people go on to file for bankruptcy. And that's not like a character flaw. It's not a huge failure. I remember a couple I spoke with one time years ago who, and this was, it'd be even a lot more money today, but back 20 years ago, there was a couple who, both of them had cancer. They were retired. All they had was their Social Security, and they had just under $100,000 in medical debt. And they may have had some other debt on top of that, I don't recall. But how in the world do you pay back over $100,000 in debt when you're retired? What do you do? So in their case, they're like, oh my word, there's no way we're going to pay this back in our lifetime. So there are some circumstances where certainly bankruptcy may be the best option for someone. What's that?
You don't want to pass that debt on to your kids either.
Oh, yeah. But to get some professional help with that, with one of CCOA's caring financial professionals, CCOA's phone number is 479-521-8877. There's more info on our website at CCOA Cares, and then there's also a appointment request form that's pretty short on our homepage on our website. Now I love this debt roadmap. This debt roadmap, and I only got one slide left after this, so I'll take whatever questions you had. I think you had some credit questions or something that we can tackle. But this debt roadmap, how do you deal with your debt? Well, attending this class, check. Learning about some strategies for debt, check. Kind of mapping out your next step, check. So you've done those things. Choosing your priority debt. For example, I owe $10,000 on federal student loans. Prioritizing this total debt, I want to minimize this total cost of So whatever you want your priority to be for your debt, jot that down. I'll give you a moment to do that. And then what's your plan for your payments look like? And they have an example of, well, I can put $100 towards this debt every month. After I pay off that debt, I can take that extra $100 and I can put that into emergency savings and build that up. So that's a sample plan. So I'll give you a moment to chew on what your sample plan might look like for you. And then getting free help, you can always talk to one of the debt experts that we've got at CCOA. And celebrate your victories. For example, when I pay off my big priority debt, I'm going to celebrate by, going out to dinner with my family at our favorite restaurant or that kind of thing. Maybe not celebrate by buying a brand new, Corvette or something.
Right.
Some people can do that kind of thing, where people can leverage getting into a whole lot of debt with a little bit of money, like tax refunds.
Yeah.
Maybe someone will get a $3,000 tax refund, for example, but instead of using that to build up their financial stability and their emergency savings or knocking out a debt or something like that, sometimes they might say, well, I'm going to put that down on a new vehicle. And the new vehicle is a, $30,000 new vehicle or something, or, $40,000. And it's like, well, now you're choking on, monthly payments of, $698 a month or something. So,
Yeah, that's wild. I don't understand that mentality.
yeah. So celebrate at the finish line, but, not go too nuts. So, well, what questions did you have? I think you had something about credit or credit reports or something like that.
Yeah, I just basically, I need help on reaching out on defaulted loans and figuring out, and so that'll just come down to me doing a plan, I think, with CCOA. Really, well, my question was about, is it worth it to work with a debt consolidator for loans that have already defaulted, have already been sold off, right? On the other side of things, right? We're already past the, the DMP. It's just a years of neglect and flying by the seat of my pants.
Sometimes if you
How
reach
do I
out,
approach that?
yeah, I would say definitely talk to one of our counselors about that so they can look into the specifics. Because sometimes when you inquire about a debt, it restarts the clock, and it's like, aha! So sometimes it's not really in your best interest if it's been a long, long time to kind of reopen that kind of a thing. It just depends. So there's lots of different laws and things that can come into play for consumers, that strategies that our counselors can talk to you about and take a look at your specific situation and what comes into play.
CCOA would handle too. That wouldn't be like a legal aid conversation. That would be a legal aid of Arkansas. That would be you guys could actually consult on that somewhat.
You could definitely talk with one of our counselors to consult about, what with those debts would still impact you however many years later and so forth. So yeah, so they can definitely.
Like with my student loan debt, it wasn't very much, but they never garnished my wages or came after me for it. And from what I understand, it was because the co-signer, my grandfather, passed away, so
Wow.
they couldn't come after me. They could wreck my credit, but they couldn't actually take action to take it back, I suppose. Some kind of like loophole like that, but
Okay.
basically, I'd just like to have a plan of attack to
Sure.
look at that and just some small, debts that were sold off here and there, and
Yeah.
years of recklessness, and kind of, approach that and get my credit score up is my goal.
You
So,
bet.
Yeah.
Have you pulled a copy of your credit report anytime recently?
Yeah, I need to again.
Okay.
Yeah, so that would tell me then where all of my liens are, all of my,
Yeah.
yeah.
Because sometimes people will say, well, I don't really know who all I owe or how much it is now. And so that's a great place to start, to say, well, let me pull a copy of my credit report, because, if I owe ABC company money, it should be on there. So yeah, it sounds like you've got, and that's, you would go to,
Fortunately, it's not very much. I've been great about not accruing debt, otherwise, not financing really anything, and keeping myself healthy. My wife has student loan debt, but besides that, we're pretty
Okay.
clear, comparatively. I think.
okay, not a lot of debts.
Yeah.
Okay,
Yeah, just
great.
the back ones and getting that credit score up, so we can buy a home. and stuff like
Okay.
that.
Well, good deal. Yeah, and definitely looking into old debts, and talking to our counselors about what can be done and what's best in your case to do or not, and so forth.
And then on the same note, sorry to interrupt, you would recommend not going to a, debt consolidator essentially, even for those old defaulted loans, right? You would recommend like approaching it yourself, having that conversation with these individual companies, and trying to work out.
With old debts and so forth?
Yeah.
Like I said, I would definitely talk to our counselors before you talk to those creditors, because in some of those cases, you're trying to do the right thing, but it's like you shoot yourself in the foot.
Yeah.
Because it's like, oh, you just restarted the clock on those 7 years or something like that. And it's like, oh, are you kidding me? I was trying to do the right thing here. And
Just waived, forgotten?
in certain cases with certain kinds of debts, if they're like written off and already and charged off already and so forth. Yeah. So those are the kinds of things that
They disappear?
that's the kind of thing that merits a discussion with one of our financial experts who can talk with you and say, okay, now here's what sounds like going on with your situation. Here's the ramifications of what's going on now, or the worst is already over and it just gets bad if you touch it again, or so they can get into the specifics a lot better than I can. But yeah, that would definitely be worth looking at. And the big thing about raising your credit score, besides that kind of thing too, of course, but there's 5 main factors, and 2 of the main factors total 65% of our credit score, and that is how much we owe and how timely we pay. So,
And that's not the amount, that's just how being current and never being late on payments?
so how timely we pay is just pay on time, don't ever be late.
Gotcha.
One late payment, FICO says, can knock down your credit score by as much as 100 points.
Jeez.
Yeah, so that can be a bite. And then how much we owe, FICO likes that we have credit and that we use credit, but conservatively. So if we owe a lot,
Yeah.
even if we're paying on time, and you're like, well, yeah, I owe a lot, but I make a lot and I'm fine. FICO credit-wise, they're like, ooh, boy, you owe a lot. We don't like that. They're very conservative. So the 2 biggest things we can do, 65% of our credit score, is to pay on time every month, and then to knock down our debt. And the lower our debt, the higher our score. A basic rule of thumb is less than 30% is what is best. So if, for example, you had credit lines that totaled, let's say for the ease of math, $1,000, and you had, we'll go with 10,000. So say 10,000. If you got multiple credit cards and your total credit lines total $10,000, if you have your debt under 3,000,
Okay. Less than 30% of your credit line?
good. So yeah, if keep it under 30% of your credit line,
Gotcha.
they really like that. You'll really get dinged the more you go up. In fact, one time years ago, many years, gosh, this is probably when I first started working at CCOA, maybe around 24-ish years ago, 23 or something. But I was getting mail that said, Mr. Foster, let us help you improve your bad credit. I'm like, improve my bad credit? I don't have bad credit. I pay all my bills on time. What are you talking about? But I kept getting more mail like that, more, and I'm like, okay, this is starting to scare me. Is there identity theft going on? What is the deal? So and this is before we know all that we know about credit scores today. Back then, they were like, we're not saying nothing, And so I called a friend of mine who actually worked at the credit bureau in Fayetteville, and I said, hey, I'm getting this mail. I'm kind of worried something bad is going on or whatever. But she was zeroed right in on it because she knew the inner workings of credit scores. And she said, do you have at least one credit card that's that you're maxed out or close to it? And I said, I got one card that's it's not maxed out, but there's a lot on it. It's, I guess, somewhat close. And she's like, well, that's why. That's why I'm getting this mail that says, let us help you with your bad credit. I'm like, but I'm not late. She's like, I know. I said, I'm not over the limit. She's like, yeah, I know. So this was the kind of thing that they didn't want to tell us about credit scoring. And the credit bureaus knew, but the general public didn't know, and so forth. And Congress said, you need to do a little better job telling the public what goes into their credit scores.
Especially for a system that you have to pay to play. You have to buy in.
Yeah.
It's like to build credit, you have to be a part of the system. If they're not going to explain to you how to use it, then that's kind of a little...
I tell people it's like playing a game you don't know the rules to.
Exactly.
I mean,
the fact that I didn't come out of high school with any knowledge of this, and that everybody is completely entrenched in student loan debt without any knowledge of what other options are, it's just expected. Right?
And the credit folks said, well,
Good luck.
that's like our proprietary info. We're not going to tell people.
No.
And then Congress said,
we have to play your system,
Yeah.
play your game.
and Congress said, well, if you aren't more forthcoming, we're going to make you. And so the credit folks said, okay. So then they came out and started telling us stuff like, okay, there's 5 main factors, and the biggest 2 total 65% of your score, how much you owe, how timely you pay, those total 65%. So then they started giving us enough information that we could say, okay, now I know how. They don't tell us everything, but they do tell us enough that we can improve our scores.
Yeah. What are the other 3 factors do you recall?
One is like a mix of credit, and they don't tell you what that looks like exactly, other than to say something like, well, if you have a student loan and a credit card and a car loan, we like that better than I got 2 credit cards and that's it. Okay. So they like some kind of a mix. Recent inquiries, if you've got like more than, if you tried to open up a credit card more than like once or twice a year kind of a thing, that can ding you. It's roughly 5 points, roughly, whenever you do apply for something. But they don't like if you apply for credit very often, because it's like, ooh, hey, this guy going on a spending spree, or what's going on? And then, off the top of my head, what was left? So a mix, inquiries, age, history. Do you have a nice long credit history, or is it pretty short? I remember one time my mom said she called her credit card company years ago. There was a credit card company called Wachovia, and she had them for like 18 years. And she called with a question about something, and she said, yeah, I would wanting to, I've been a customer for almost 20 years, and I had a question, but no, ma'am, you haven't been a customer for 20 years. You've been a customer for 18. She was just like, well, excuse me. She's like, wow, So here she'd been a customer for nearly 2 decades, and somebody was really rude to her, and she said, well, I don't think I want your card anymore. You can just cancel my card then. And I was like, oh. I'm like, that guy didn't care. He was like, okay, But for her, she just got rid of a credit card that she had in good standing. She was never late or anything for almost 20 years. So that doesn't help your credit score if you do something like that. So yeah, hold on. FICO says, Fair Isaac Credit Scoring Company says, closing a credit card account out will never help your score, and it usually will hurt it. So, so that's another credit scoring thing to consider. And congratulations, you created your plan there. And if you would, just kind of fill out that short survey there for me. Welcome your feedback. And if you're willing for me to email 4 months or so down the line, I think it's a 3-question follow-up. It's even shorter than that, as short as that is. Capital One says, please do a very brief follow-up with people. If you just jot down your email address, that's all I'll use it for, is just to send a 3-question follow-up in a few months. Let's see. Interesting. Okay.
Mark, you look up here in Fayetteville. Mark, you live up here in Fayetteville?
Do I live in Fayetteville?
Yeah.
Oh, no.
What town are you in?
Our
You're saying
office
you
is
guys
here.
flooded.
But it was Rogers that got flooded.
Rogers, gotcha.
It was, yeah, it was